we'll start here. Thank you very much, everybody, for joining. I'll briefly introduce myself. I'll spend literally no more than 15 seconds on what Lexia Analytics does, and then I'll get straight into it. My name is Jelle de Jong. I'm Dutch. I am originally from Amsterdam, studied in Delft, then worked for McKinsey in Amsterdam and New York, and then joined Diageo. Spent 2 years in London working for Diageo, and then became head of commercial finance for Diageo in Australia. I effectively then basically spent the next 15 years in Asia, and in Asia Pacific, effectively in Australia. Lived in Hong Kong, lived in Singapore, and spent a lot of time actually in Vietnam. I did quite a bit of work on Johnnie Walker distribution in Vietnam, and as a result got to sharpen my teeth on revenue growth management in Asia. This particular topic of customer profitability I have a lot of passion for it, because whenever we would actually go into a new market for Diageo, the first thing we would do is we would actually figure out, okay, where are we actually making a profit? Because the problem was that very often in those markets, what we found was that we knew we made a profit somewhere, because at the end of the year, at the bottom line there was a profit, but what drove that profit was not always clear. So today I want to take you through a little bit of the power of having customer profitability at a very granular level, and the importance of granularity in reporting at the same time, whilst at the same time also being very clear on the fact that this is not something that you have to just. This is not a religious thing either, which sometimes it does appear to be that in this age of data science, the more data the better. I don't think that's the case. Very briefly, 15 seconds on Lexia Analytics. Lexia Analytics was set up by me and Wouter van Rij, also Dutch, and we've got in Singapore, we've got Yiwa Ching. We focus on RTM software for mainly on fragmented and developing markets, so mainly Asia, Africa, those type of markets. And we basically do a piece of software, and we do a part of our work is consulting. We've done a lot of consulting over the last year. Things like trading terms, pricing platforms, promotional effectiveness, and then also S&OP optimization. And our majority of our clients are either fast-moving consumer goods companies, or we also have a number of retail clients. About today. Very simple, basically 4 elements. In times of high volatility, profit becomes the primary concern. Ultimately, it's the ultimate question. Is something making a profit or not? And if something isn't making a profit, something has to be done. If it is making a profit, at least there's a future there. Second part, though, is this is clearly no news to anybody. And if you tell clients that they should focus on customer profitability at a granular level, then they look at you like, yeah, all right. But actually, once we start digging down, it's okay, what's the granularity of this reporting and this analysis? Then it becomes very obvious that there's data and system challenges which make that very hard, which means you end up in the world of averages. I'll spend a little bit of time on one particular issue, which is often in the contract bidding for in organizations. That can be in fast-moving consumer goods, can be the food service contract. It could be B2B contracts that a certain, for example, coffee companies have. It could be the on-premise contracts that are being done by alcohol companies. And effectively, there you very obviously that is not always a very well managed process. And then finally, I will discuss granularity. I think that on the one hand, very often we lack the granularity, and then on the other hand, there's a bit of a risk that we go off the deep end on the other side of it, and that we spend an awful lot of money trying to get better data science. So the beginning, the main concern here in terms of profitability. Sorry, I see once in a while I see everybody flicking on my screen. That's basically come through in the waiting room. Profit is clearly a major concern at the moment. I think this was almost already an issue when I spoke last time on the webinar, which was at the end of last year. But what a change it has been since. Even between visiting Vietnam late last year and this week that I'm here now, the difference is palpable. We sort of felt there might be a little bit of a change of the trend, but it feels like that trend has definitely changed. And the words of Larry Summers that I put back on here again is really are more true than ever. This is a moment where there are so many separate aspects and cross currents of issues that it's quite hard to see. It's not one major issue that's happening. There's a multiple of issues happening. And we've also, as a business, done a lot of work over the past year with businesses that, you know, they were coming out of COVID. They suddenly saw a burst of activity, and they usually hadn't provided for that in terms of stock. And almost tragically, just as they sort of were back on their feet in terms of replenishment and had sufficient stock to actually service this growth, they then found that the market had changed. And I think that leads very much into our conversation here today as well, as is ultimately in times like these, when there's so many uncertainties and there's so many parameters that can go either way. We don't know how long the war in Ukraine is going to go on. We don't know what the long-term impact is going to be on energy prices. It's there. Inflation is proving to be much more resilient than expected. Real estate prices in a lot of parts of the world are suddenly coming down, whereas we've just seen in some markets like Australia, we've seen decades of real estate prices going up, and suddenly we're seeing those real estate prices coming down in a way that we haven't seen before. So with all these uncertainty and all these uncertain parameters in our lives, the only thing that really you can hang your hat on is if you make a profit or not. And Peter Drucker said it very nicely, that it's not the purpose of a business, but rather the test of its validity. When I was a finance manager, I often had to go up against sales and marketing on commercial decisions. And these were often trade-offs between brand building, for example, and short-term targets, or a customer relationship and profitability. And you know, I know I won some of them and I lost some of them. Because it wasn't necessarily a clear-cut case. But I always found that there was one argument where I never got much resistance, which was if a particular initiative led straight to a loss-making outcome. If something made a loss, then the conversation was brief, because clearly somehow profit really was king, and everybody in the business understood that clearly you could not go around creating losses. And therefore it's quite strange actually that whilst businesses know their overall profit or loss position, they often don't understand at a granular level. They know at the end of the month that they made a profit. They know at the end of the year that they made a profit. But exactly what drove that profit is very often mercurially unclear. And it reminds me of the fact that when I was a very young lad and I started at McKinsey, you had these old directors walking the hallways and telling their war stories. And it became very clear that this is something this has been around for a while, because when they were growing in McKinsey in the 60s and the 70s, if you really looked at what McKinsey did at the time, a lot was activity-based costing, literally figuring out what was the profitability of individual product lines, individual services. And because companies didn't have the amount of IT infrastructure that they have nowadays, these things were even more elusive then than they were today. So they spend a lot of time just calculating those type of analysis and finding out that actually of the 800 SKUs that the company made, the top 200 were much more profitable than the other 600, or in the same for service lines. So this is something that's been around for a long time. This same McKinsey did a piece of work. It was around, I think, 2006, 2007, and they called it the granularity of growth. And there was a focus on the granularity of growth and performance. And one of the things that they found was, and that's something that I've seen come back again and again, one of the things that they found was that actually most businesses focus in their reporting, in their analysis, on a granularity level which is simply not low enough. And what they showed through this analysis here, which is just more of an indicative than the final say on this, is that by looking at the correlation between, and R squared means the correlation, how much can you relate a certain parameter with the performance of that company, that they found out that if you go to smaller level of granularity, performance becomes a lot more explainable. And that was very powerful at the time, because actually most companies looked at it on a category by country level. But actually you found out if you looked at a channel by region level, that there was a lot more to be found and a lot more to be understood about that. I will show some examples of that later as well. The second thing they did in granularity of growth, and that I thought it was a very interesting book, it's quite old by now, but still very relevant, is that they looked at the S&P 500. The main reason they looked at the S&P 500 is because those companies have a lot of publicly available data. So it was relatively easy to access this data. And then over a period of 10 years, they looked at what was driving the growth of these companies. And then they separated that out in what they called 3 cylinders of growth. They were consultants, so they were very good at coming up with catchy names, the 3 cylinders of growth. And one of them was portfolio momentum, simply category growth. One of them was M&A, companies, particularly the top 500 S&P companies, S&P 500 companies grow a lot by M&A. They acquire other businesses. And the last part was share gain, which you could also see as operational excellence. Now, this should give you some pause, this slide, because it goes to show that actually over a 10-year period, the amount that operational excellence, share gain, would deliver on average to these businesses was actually very small. Most of this was down to portfolio momentum, i.e. a rising tide raises all boats, and that's exactly what happened here. And there's this analysis as far by the time I spoke to McKinsey in I think 2016-17, the partner that had worked on this has proven itself over and over again. And what it goes to show is that if you want to find out how to hold your own, how to still grow, how to make the best of a potentially sometimes a bad situation in an economy like this, it's very important to look at the granular level of your business and figure out where is the growth still. Because even when a brand goes down, even when a category goes down, there are still pockets of growth, and there are pockets where you're decreasing much faster than others. There are customers where you're decreasing much faster than others. And to understand that, rather than saying, you know what, we're going to just give everybody higher targets in terms of calling on outlets and all that, is a very powerful metric. So portfolio momentum. Ultimately, the most important thing you can do as a business, because M&A is usually done. Oops, sorry, I've done some. Usually, one of the things that you've done as a business is M&A happens at a much higher level, but portfolio momentum, figuring out in your markets which categories, which channels, which regions is where there's still an opportunity to grow. That's where you actually can make a difference. Now, here we go. This is not just a McKinsey thing, by the way. There was also a few academics that spend a lot of time on looking on basically which companies succeed and which companies struggle. And what they did was, this happened in Europe. They sent a survey out to something like 2,500 smaller and medium-sized companies. And through those surveys, they tried to figure out whether these people were profit-focused or growth-focused. Now, the interesting thing is, if a company is profit-focused, if it really knows where it's making its profit, it's looking at things pretty granularly. And what was interesting is then they looked back, they basically gave them a few years, and they did the same survey, and they found out how they had been doing. And they separated them out into 4 quadrants. Those that were high growth and high profit, which you can see here on the top right-hand corner. Those that were high growth, low profits, low growth, low profits, and low growth, high profits. And what you found is that those companies that were focused on profits, basically, that some of them still years afterwards had done poorly and had gone backwards. But actually, the ones that were profit focused did a hell of a lot better than those that were growth focused. Those that were growth focused had 28% of those actually did very badly after next number of years, whereas in the profit focused group, it was only 13%. So you can sort of see how even there, every time again, a good granular understanding of where am I making my money and how am I improving on that is a very powerful metric. So here we go again. Like I said, when I tell customers they should focus on customer profitability, there's some risk of eye rolling. Actually, when we look at then the granularity that we would like to do to make meaningful decisions, i.e. the level of, for example, an individual outlet or an individual channel and an individual SKU in that channel, it suddenly becomes a lot more cumbersome. So everybody agrees that customer profitability is hugely important. And still, you know, if you ask your average client, which of your customers is the most profitable and which are less than expected, it's hard to answer that, you know, particularly if you were to do it at a category level or even at a brand level, or maybe even at a SKU level. Or if you ask anybody, okay, you sell, you know, hundreds of thousands of 9-liter cases or packs or whatever last month, which of your deals were the most profitable, which were the least? They probably could find out, but it'd be an awful lot of work and a lot of Excel, and they would probably kill 10 analysts in the process. What will we deliver if in incremental profit if we stopped all loss-making promotions? That's an interesting question. Often asked, but very hard to answer. And to what extent have we got orders that are too small to deliver profit? And how many of them did they do last month? These are all relevant questions, and any FD that looks at them should say, well, you know what, I'd like to know this. The problem being that these questions are all hidden, the answers to these questions are all hidden in averages. So it's very hard to be able to figure out those individual data points. And one of the reasons is that what I would say companies are stuck between Excel hell and the concrete that is their ERP. So when you start doing these type of analysis, really you're talking usually about millions of lines, even for a single month. And clearly Excel is going to freeze, even if you try to simplify it. The problem is that whilst doing this analysis, you're trying to figure it out as you go along. So it's not something you can already run an ERP report on. Very often the data isn't even an ERP. So what we tend to see is that companies that do this well, they step outside of Excel and they use something like Python or maybe even R to do this. The good news is, if you do it like this, generally within 2-3 months, your customer profitability cube is done, and you can use this data then to look beyond the averages. Now, what's the problem with the averages? It's the risk of missing those pockets of value by looking at averages, by looking just what the average net invoice price was, for example, for the month here. So this was a client in the Philippines, and this is for one single product they did. And what we did was we put all the different deals they had and the net invoice price of those different deals on a spectrum from high to low. And you can see here that the bottom 10% of them basically gave roughly a 10% discount versus the net invoice price. Just simply being able to track this on a monthly basis for your main products made a huge difference for this client. Because suddenly all they did was, if you knew that you were in the bottom 10%, you knew that the sales director was going to give you a call to have an understanding about why this was done. And guess what? This area here disappeared relatively quickly. And this was easy value. So they increased their net invoice price by not much, 5 pesos per bag, what it was. But ultimately, in a business that was very low in terms of marginal profitability, this made a difference of about 15% on that particular product. So the looking away, and this is just one single product in one single month. You can understand that if you do this across all products in all months, that you're making a big difference to the business. I don't know why sometimes it goes back, but anyhow. So this is really not rocket science, and this is why I would encourage everybody to either do it themselves or find people that can help them with this. Very often what you do is you take either the scan data people have, loyalty program data, any product data, any financial data, any sellout data, either through the data warehouse or through CSV files. You make sure that you understand that it's structured and cleaned, and then you basically build per transaction. You build a P&L. So you build an individual transaction per P&L, per P&L. Each individual transaction, actually, or to be more exact, very often per individual SKU in a transaction. So that means that every SKU that was sold in a transaction has got a P&L all the way to gross profit, and sometimes even to marketing margin profit, or contribution after A&P, as we used to call it, the Diageo. And then you have that basically at the smallest level. You know which outlet, which customer it went through, and you know which products, which SKU we're talking about, and from that moment on, you can basically size up from there relatively easily. And the power of a cube like that is in its granularity. For clients where we have built it, they've got a dashboard at the level that they need. They've got management reporting, and more importantly, they use it as their database for all their individual ad hoc analysis. So custom segmentations, analysis of drop size versus profitability, etc. So it basically it gives you a cube of very granular data, which you then both can use for monthly reporting, but also for your ad hoc analysis. And what do you do with that? For one client, we looked at the we looked at the minimum order size. We looked at which orders, how much profit did you make by order? And we found out that actually 1 out of 6 orders for profitable clients were not profitable because they were too small. Because when you get to a smaller order, you very often have to split a pack. You know, it's suddenly the fixed cost of the logistics became a big burden and all that. And actually, what you also found out that whilst 1 out of 6 orders for the profitable clients were actually not profitable, actually they made up something like 2% of all volume, of even less. And most of that, 95% of that was earned back when you force people to take a minimum order size that had to be bigger than what we had here. Very simple, by being able to say, okay, what's the profitability? What you very often see with this type of stuff is that you look at small orders, and that small orders is usually for the smaller SKUs, where then also very often goes to smaller customers. So once you actually, if you average that all out, it still looks okay. But actually, if you look at the specific orders, you find out that actually it makes no sense. Now, if you are selling perfume, or you're selling Johnny Walker Blue, this might be of less relevance to you, because actually your product margin is so high, and your gross margin after COGS is so high that actually, you know what, even a less profitable order is still profitable. But if you are in milk, or if you're in sparkling water, or if you're in cement, or if you're in consumer electronics, then suddenly small orders start to become, a significant drain on your profitability, and are therefore an interesting point to sort of say, okay, let's use this type of analysis to look at it. This is something very similar. What we did as well for one of our clients was we looked at their SKUs, and looked at in terms of their profitability and also in their contribution to the business. You found out that the bottom 40% of SKUs only contributed 1% of their profit. And whilst this was not a complete surprise, once they saw the hard numbers, it was a bit of a surprise. So the surprise was not so much that it was low. The surprise was that it was this low, and that actually had a negative marketing margin for a lot of them. This is again, the smaller SKUs usually come in the smaller orders, and then they often go to smaller customers, because if it was a big customer, they would go to, usually the order is by its own nature already bigger, and then very often it's not in the bottom 40% of your SKUs. This doesn't still mean that there will be SKUs you'll need to keep in there, but it's a very good way to look at your business, because if 40% of your SKUs, whilst also it's not the biggest part of your business in terms of volume, they all need a little basket in the warehouse. They all need to be reordered. They all need to be taken care of. They need to be maintained. So actually, it does cause an awful lot of work for the business. Contract bidding for organizations. So this is another part where very often we actually don't track it at all at an exact level. There's lots of alcohol companies that have on-premise contracts, But if you ask them, like, what's the exact profit we're making on the on-premise contracts, they would struggle to be able to tell you. And the second thing is that actually when they do, it's very often it's hampered by the fact that it's very hard to have a level of granularity to follow this. There's 4 problems usually with contract bidding, and this can be on-premise contracts, like I said. These could be food service databases, food service contracts. These could be B2B contracts in coffee or anything like that. Lots of companies have things where they bid for contracts. Very often, there's a lack of a live opportunity database of new contracts to go after. And you really have to know what the size of the pond is. But very often, a company doesn't have a database which says, these are all, take for example, an alcohol company, these are all the outlets where I, as an alcohol company, would like to have an on-premise contract with. Of all these outlets, these are the outlets where I actually have a contract with, and I know when it runs out, and I know that I want to re-sign this, or I might actually want to let it go. Of all the contracts where I don't have a contract, when is it running out? What's the value? How attractive is the outlet from a brand building perspective? And should be who's the current competitor that's in there? By having this, you know what the size of the pond is that you're fishing in, and you know what your market is, and it's not actually that hard. It's just a matter of diligence. And what you tend to see with a lot of our clients is that they, as one of the person once said it to me, too often we are playing defense on contracts. They don't properly plan, and then very often it's just suddenly somebody comes in and says, "Gosh, we have this contract opportunity, but they're already very far down the road with X. Can we not get something going very quickly?" Second problem is very often that there's a lack of standardization in contract structure and terms. So for one of our clients, they had 200 live contracts. It was in Australia, 200 live contracts. I think there were about 85 different templates. You didn't have to accept that these current 200 contracts you're not going to be able to track. Main reason is very often that you've got things like Microsoft Word, in which these contracts are written, in which people can make changes, and customers then also ask for things. If you don't have a standardized contract structure, and it can be 2 or 3 different options, tracking it is virtually impossible, unless you want to really kill somebody trying to put every different algorithm under the sun in whatever model you use for it. So it's a bit of a housekeeping one, but it's so important. Then third, there's no consistent monthly reporting on contract performance. An MD, a regional MD, even regional president, anyhow, somebody in charge of the region said once to my business partner that he signed off on all major contracts every month, and every one of those contracts showed great financials, and I was always looking like, gosh, this is really going to benefit the business. And every month when the books were closed and the company performance came in, the management reporting came in, it didn't feel like he had just signed another 10 contracts as he's done every month of great financials. And that clearly shows you that there was no consistent monthly reporting on the individual contract performance, which means that very often then leads to, let's call it commercial optimism. And then the last thing, which I suffered a lot for myself when I worked at Diageo, was there's no post-mortem evaluation on contract bids won and lost. This is an area of urban myths very often. So you're losing lots of people tell you that they're losing everything to competition because of pricing. Because the competition doesn't care about price, they don't care about profits. They just undercut us every time. But if you ask, very basic questions, so like how many contracts did we go after, how many of those did we lose, and why did we lose them? Do we know? Have we got actually somebody telling us that this is because you offered too high a price, too little gain for the customer? Very often it doesn't really exist. And I once had a very strange situation that I worked for one alcohol company in Australia, and got all the urban myths when I was at Diageo, basically saying that all our competitors were underbidding us. And then I happened a few years later to work for one of the competitors as a consultant, and guess what? I heard the same urban myth, only the other way now, that Diageo was always undercutting them. It's been like that for years. They don't seem to care about profit. So somehow that's a very easy argument to use, but actually, and it will be true, of course, some of the time, but it's very rarely true all of the time. So here you are. Sometimes a big part of your business is contracts. to keep these, to get these contracts, the right price inside your business is hugely important. But if you don't know how many you're winning and how many you're losing, if you don't standardize in a way you can easily track it, and if you don't then monthly report consistently on that contract performance, so every sales guy knows that whatever he put in that business case is being tracked, you're going to have a very hard time really figuring out whether you're doing as well or as or worse than what you could be doing. So, I mean, ultimately from that, of course, follows a very simple thing. It's there. Granular 360-degree approach helps companies to be in control of their bidding process, helps you really realize how well or how badly you're doing. So the first thing is you need to have an opportunity universe. You need to have a live database of all opportunities out there, those of the competition and those of yourself. And you want to estimate the value, the attractiveness, and the next window of opportunity for bidding. Now, before people now think that they should go out and do a huge census on all the outlets that are out there, 9 out of 10 times what will work here already is just to ask every sales guy in the field to make a list of, depending on what type of business you're in, of the top 10, the top 20, the top 30 outlets that he thinks we should be bidding for. Just a list, and then some estimate of value and some estimate of attractiveness. And very quickly you will have a database that will at least give you a feel of how many of outlets are there that we really would find interesting. And then the only thing you have to do is you have to send the sales guy there to find out who's currently got the contract and when the next window, when it ends. And then suddenly you have a very powerful database that actually suggests exactly, which on a bi-monthly basis you can look at and say, okay, which contracts are coming up for negotiation and how much are we interested in going after. Standardized contracts, I think I spoke a lot about it already. Once you've got your standardized contracts, it becomes very easy to track them. You just put the sales data into whatever model you use, and you can basically then use the algorithm that you use to track against performance. And the third one is contract performance management. It's a simple way of connecting the dots. We had an opportunity, we made a proposal. For this proposal, we made an estimate of what this contract would be worth. And now that we're running this contract, we're managing this contract, every month we track to what extent we're actually living up to that business case expectation. Initially, that might be a slightly depressing exercise because very often this is not as good as we'd hoped. But the good thing about that is the feedback loop creates a lot of realism in the business. And as a result of that, over time, your bidding becomes better. Your managing of contract also becomes better because sometimes the bidding actually was right, but the way we're managing the contract, the way we're trying to extract value from that contract is not right. And then at least every 2 months, you have basically a bid evaluation, scan, and plan. So you evaluate which bids did we win, and which did we lose, and why did we win them, and why did we lose them, and who did we lose them to, of course. Which contracts are up for negotiation in the next 2 months, which ones do we want to go after, and who's going to take the lead on each of them. And is there anything we've learned out of the bid evaluation that will change the approach we have? Once you do this, and for this, of course, you use the opportunity universe, which you keep live. Once you do this, it's very hard to make really big mistakes. And actually managing contracts then in terms from managing the process around bidding, I'm not saying that, that everything else is easy, but that part then becomes a lot easier. And then also you've got, again, a very well-structured granular database of performance, which you can use going forward to figure out how to, either win more by lowering prices or, maybe extract more value by increasing prices. Finally, then granularity. I've used the word a lot, and I just have a few words of caution here towards the end. Let's see, we've got 18 minutes left, so I've done all right time-wise. I know that I actually spoke quite highly about data and the things that data can help you with, but weirdly enough and paradoxically enough, we're sometimes expecting too much of the data and without really knowing what to expect, which sounds weird. But when we just started Lexia Analytics, we were called Lexia Analytics, and then people call you up and say, I need an analytics solution. And then remarkably, quite often what happened was I would actually be asked, can you build us an analytics solution? I would ask, what do you want it for? I said, well, we don't know yet. And this happened at quite a senior level. And there does seem to be an infatuation with the promise of data to solve all problems. It's almost a religious belief sometimes. I see very often companies recruiting data scientists, and they recruit people with beautiful credentials, amazing CVs. They pay them well because it's a well-paid job these days. But they have no idea how the company works as a commercial entity. So they're really being thrown off the deep end. Here's a whole bunch of data. You go tell us what we're missing. And the idea that a big dashboard of data will simply, by its existence, unlock value is a terrible fallacy. So I'm a little bit hesitant. I've seen a lot of this go wrong, particularly because we're focusing too much on the fact that if we just unlock the data and get it all in the right spreadsheet and in the right Power BI cube, then actually it will by its very mere existence will suddenly unlock insights that we'd never had before. This would be, it's undoubtedly will happen occasionally, but I would be very, it doesn't happen very often. And this is a little bit what you very often see here is the promise of deep insights, artificial intelligence, ChatGPT, GPT-4 nowadays. It drives very often a top-down investment in data, and it often is it ends very often in frustration, in a lot of cost, but not with the benefits that were once hoped for and almost religiously believed in. What you tend to see is what very often happens is people realize here in the main areas of work that actually they've got all this data. And one of the things is they will start mapping that data. They will figure out how much data they can all connect to each other. Then there will often be a period of data cleansing and structuring. Very often in this situation here, the people actually in the line that we should actually be using the data are not involved much. They're being promised this amazing dashboard, but at this stage they're not being asked, okay, what insights do you need to make better decisions? Then in the end we start building dashboards and report building, and then you see very often a bit of a frustration here because you've built this dashboard, you've spent a lot of money on it, and at this stage you're telling the people in the commercial function, okay, now now we need to see a return on this investment. And the easiest thing that then the commercial function, they can say, well, actually this data isn't right, or I don't believe it's right. And then you suddenly chase your tail in getting the data right. And the dashboard becomes something that's inflicted on people. Because all you were hoping for is this amazing insight generation at the end, which suddenly would unlock all this value. And really all you've done is you've unlocked a hell of a lot of frustration, both from the top management, because they've just spent a lot of money and they're not seeing the return on investment on it, and also from the people that are actually the people that should be using it, because they've suddenly got this dashboard. And the worse, the wider you go initially and the deeper you try to go at the same time, the worse it gets. So companies that try to do it for the whole of Europe or even for our whole globe in one fell swoop, or even with a pilot country, but with the thought that it soon was going to be just a matter of scaling it up, they find themselves in horrible territory, because particularly when you get to commercial data, the ERP data that you have at the back end, although there's people that tell me that even there's huge differences. The way we do bookkeeping in Romania versus the way we do it in Hungary versus the way we do it in Poland versus the way we do it in Australia is actually not that difference. But the way we do trading terms in those countries is hugely different. The way we do pricing, the way the different customers have power or not, or lack power, is hugely different. So that means that actually scaling up these type of data structures is much harder than we would often like to think. Where I have seen huge success, and literally not just with us, but also with some of our competitors or people that we occasionally work with, is the other way around. Is not to focus on the data as a whole initially, but to focus on where the energies are and the questions are in the organization, and make these leading and scaling up. So what does that mean? That means very simply that the commercial finance function will have questions. They will say, listen, if we only knew the answer to these questions, this would help us a lot. And then you need to help them and think, okay, well, what exactly is the question you want to answer? What's the report you would like to look at? And then you make maximum of 5 business cases for these type of data. So actually, if we would know this, and then we actually, that would really save us money or help us generate more profits, more sales. And then with those, you said, okay, what's the minimum MVP, minimum viable product? What's the minimum viable product data model that we can address these first areas of opportunity? And very often of those 5, you find out you can only really do 3. And then maybe of those 3, there's only 1 that actually delivers a real tangible benefit. But then at least you've got something. And you've started with the energy in your organization. You started with people in the organization that, you know, what would really help me is this. Rather than telling them, just go away for a while, I will have a few questions along the way, but you know, if you give me enough time, at the end of this, there's going to be a beautiful dashboard. This is a recipe for disaster. And it's a much better approach to say, actually, what we're going to do is we're going to take your questions first and we're going to make those leading. And when you then do that, you know, it will still be hard work, but at least you're working on the things that matter. What this will bring you is less frustration. It will bring you a level of excitement because you're helping people with their questions and their issues. After you've sense checked and actually make also commercial sense and address those. What you will also see is there will be some realism, you know, where there is no data, you can't necessarily create it. Or sometimes it will take a lot of time to do that. And, you know, it's not like all these businesses have been run terribly for the last 25 years and just a little bit of data will suddenly unlock huge pockets of value. So I think it would be a healthy mix of excitement and realism, but where you are in control and you realize what you're doing and what you're working on within the limitation of your business. This is one I always find fascinating. Is, you know, we can speak to businesses and they will tell us that they're building this major dashboard globally. But actually, they're sitting on a lot of data itself. For those of you that will recognize this, this is probably one of our somewhere in Thailand. But you know, a lot of clients have DMS systems. DMS systems are distributed management systems, which have an amazing granularity of data. They show you every individual order by outlet, usually what volume was bought, what the list price was, what discount was given. And give you an enormous insight in what's working and what's not. A promotion was done so often as well. If you connect that very often with the profitability data in your SAP, that comes from SAP in terms of COGS and other logistics charges, you can very quickly get a feel for you know, what's generating profit. And then the last slide is for example this. You know, where granularity really works is by looking at what's driving our profit and what's not. And what you see here is one of the things we wanted for a client in Australia. So and you can do this over a month, you can do it over years, depending on how long the data you have. This a month 1 and month 12 of the year, you usually had all sorts of end of year fluctuation. We kept those out. So we did month 2 to 6 and month 7 to 11. We said, okay, month 2 to 6. We made 24. We sold 24,000 or 24. I think 24 million cases, but doesn't matter. And we sold, let's assume it's 20,000, and we sold 20,000 in the second half of the year. So we went down by 14%. But what's very interesting here is that actually we only lost it with 1,880 of our customers. That's where we lost it, and we still won quite dramatically with 772 of our customers. So the obvious thing is, like, who do we win it with and why? There's a whole bunch of customers, nothing happened. And then there's a number of customers where all the losses came from. Sometimes this is even more extreme. You can see it here in the bottom right hand. 203 customers out of a total of something like 4,500 or 4,200. Out of those, 200 customers delivered, you know, a majority, a very big profit, a very big volume growth. And the majority of customers did nothing. And then there were 300 customers that delivered most of actually quite a significant downturn. Now, this you can then very often cut down again to, you know, which cities, which regions, which customer segments. So one of the things that we found here was that actually our big box, because we've done a lot of promotion with them, were the ones that were growing it, and that our convenience stores were the ones that were losing it. And that's terrible, because actually this is where, you know, you've got much more, much smaller packs, much more penetration possibilities. This is just big box. So whilst this looks good and we were growing 10%, actually we're growing 10% in the wrong way. We're growing it with the big box customers, and we're losing it in a lot of our convenience customers. So this was just to show that, and for this we didn't need to build a dashboard globally with, you know, 85 people in-house working on this from Accenture. A lot of this was done with a little bit of Python and using the data that was available in the business. And as a result of that, you know, a lot very powerful insights that then helps the business make better decisions, i.e. less promotions, big box, more promotions on convenience. And with that, and with 7 minutes to spare, I think I've come to the end of my presentation, and I want to thank you all for joining me here today. I think it's
wow, thank you.
Yes.
Over to me. Well, what an insightful story, and not only on a management team level, but I think that there's also amongst the viewers some people that, let's say, work in the departments of digital, and that can also use your advice. Had to, let's say, make use of the low-hanging fruit in the existing data in the organization. So I thought that particularly struck me, and I do have one question, and I also want to encourage the audience to think of a question or to ask a question. But my question was around AI, and we see this huge uprising of artificial intelligence everywhere, and I can't help but think that perhaps AI could start doing parts of the work that current data scientists, data and analyzers are doing. What is your take on that?
Yeah, I think we would first need to define what art. Sorry, I can be heard. Yes, we would first need to define what artificial intelligence really is, because it's a very big term. And artificial intelligence, in the way a lot of people will know it, as, you know, Chat GPT, GPT-4, or like the way Tesla currently does its well, tries to get to fully automated driving, etc. Those are systems that are incredibly data hungry. And the problem I see in a lot of Asian markets is there's the granularity of data, and the cleanliness of data just isn't there to be using them for those type of models. Then you go down and you say, okay, well, are there any, you know, are there statistical models you can use? And there's definitely those, but even there you have to be a bit careful. You have to know how to use them. I think the low-hanging fruit is much easier, is much more sorry, I suddenly see myself in full. The low-hanging fruit is the much more obvious analysis. I think by the time you're actually looking actively at deploying sophisticated statistical algorithms, or God forbid, even something like a neural network, I think I might be retired by the time that happens.
Yeah, right. Understand. Yeah, well, that's what they said, of course, a few decades ago, when the first 1 MB chip was invented, and look at where we are now. So the developments they go really fast, and with Lexia Analytics,
you're completely right, and I will be honest to say, I'll be very honest to say that I was also impressed and surprised by Chat GPT when it came out. You know, I think, you know, then again, even Bill Gates was. I think that a lot of us thought that was still, you know, 4 or 5 years away at least, and when it then suddenly arrived, particularly given how disappointing a lot of the other ones, the Series and the Alexas and all those were. Was those large language models are definitely impressive. The problem is they're also very good at seeming impressive, that when you then actually ask a question that needs more insight, you know, you suddenly find that it's algorithm. The objective of the algorithm is to find what's the most obvious answer to your question based on the language that they've seen. So it's not like if you ask something that they haven't seen much, then you're going to struggle. But having said that, the fact that he could do some of my Sinterklaas rhymes for me was quite impressive.
Yeah, yeah. Well, that's for me too. Well, you have mixed rhyme border book for that, of course, which cannot be replaced by any AI chatbot. However, let's just have a look at what the viewers, if there's any questions from the audience. We've had about 32 participants, and we've had them throughout the whole session. So thanks very much for staying with us throughout this whole presentation. I think plenty of things in there that you can, even if you're not a business leader yet, can use to, let's say, improve the business or the department of the business that you're working in, to also to make a good impression in the business. Are there any questions from the audience from Vietnam? See, for example, that Thomas Snook, I know him very well, has been listening in. Thomas, do you have anything to add? What did you think about the webinar?
I think it was really insightful, Guido, and what I fully agree with is indeed you need to do things bottom up. If you just from the top down build a big database, then you will often not get the results that you were hoping for. So that's also what I have been doing here locally. Try to answer the questions which are there in the departments and then help them with those, and that will really get you going forward and deliver results much quicker. So I fully agree with that point that Jelle made.
Yeah, thank you, Thomas. And Jelle, for you, is that being the founder of Lexia Analytics, which may seem like a company that builds global dashboards for enormous solutions and enormous amounts of money, and that is clearly something in this session that you say you're actually approaching it from the other way around, much more bottom up than top down. Is that something that you have to battle a lot against such an image as Lexia Analytics, or?
No, we don't. I don't think we have that image with our clients, which is good. No, I think we've always been seen as being relatively pragmatic.
Yeah.
And I've also, having been in the position of a finance manager myself, I sort of understand the dynamic, and you want to help people. The nice thing in this thing is also, like Thomas already said, if you work bottom up and you work with the people, the frustrations and questions people have, you can very quickly show a benefit to the business, and ultimately success breeds success. So yeah, the focus here has to be how you help people, and then the rest will follow, rather than telling everybody to sit still for the next 18 months whilst some amazing global template is being rolled out.
Yeah, no, absolutely so. And I think we can all agree with that, with the idea of being able to be in control by yourself, by asking the right questions and then finding solutions in a pragmatic way. Jelle, I thank you very much for this webinar, for providing our members, especially in FMCG, with your insights with the term customer profitability, which is a very broad term, but we've managed to tackle it into a few very insightful slides. Thank you so much for that. And I would like to also thank the audience for coming, for making time in their busy working day. It's 5 p.m. now, so the traffic jam is about to start. So without much further ado, let's get to our motorbikes and let's go home. Thank you, Jelle, and thank you, everyone. All right. Bye-bye.
Bye-bye.